Brian got the call he'd been waiting for. A strategic buyer wanted his business. $18 million, clean deal, everything looked perfect. Then his CPA called with the tax projections. Unfortunately, he owed $4.2 million to the IRS. Suddenly, that life-changing exit didn't feel quite so life-changing anymore. My name is Chris McClure, and for the past 30 years, I've helped business owners navigate exits. And the difference between a good sale and a great one, it usually isn't the purchase price. It's how much of that check you actually get to keep. When Brian and Joanna came to us, the letter of intent was already signed. But when we reviewed their structure, something jumped out. They were actually eligible for something called qualified small business stock treatment. But no one had mentioned it. With the right coordination and a quick timeline, we actually restructured a portion of the deal, and we excluded over $6.2 million from federal capital gains. That's $1.4 million extra they would have wired to the IRS if someone hadn't caught it in time. Most owners never hear about that until it's too late, and by then, it's untouchable. But QSBS is just one piece. When you save that much money on your life's work, it changes how you think about everything that comes next. If your business is a C Corp and you own the original shares and you've had them for 5 years, you could potentially exclude up to $10 million from capital gains tax under something called QSBS. But it's also one of the most misunderstood. We've helped clients restructure their corporations from S Corps into C Corps to make this possible. We've also helped families coordinate with spouses and adult children who might each have their own $10 million exclusion. One family we worked with had both spouses and 2 adult children, and they were all eligible. When they sold their company for $45 million, the family was able to exclude $40 million from federal capital gains tax, and it was completely legal. The peace of mind that comes from knowing you've handled everything right is impossible to put a price on. And timing can actually make an even bigger difference. If you take the full sale price in a single year, your income jumps up into the top tax brackets. You have federal capital gains, 3.8 net investment income tax plus state income taxes. At around $496,000 of income for married couples, your 15% capital gains jumps to 20%. And if you cross $517,000, you add the 3.8% net investment income tax. And if you go a little higher, you're looking at Medicare charges. And those Medicare charges can last for years. We worked with a client who restructured their $10 million deal to receive $6 million upfront and $4 million over 3 years. That simple change kept them under the 23.8% tax bracket and saved them nearly $500,000 in taxes. You see, when the planning works, the relief is immediate. And there's also another approach most owners never think about. It's called cost basis planning. So if you've held your business for decades, which most people have, your cost basis, it might be literally zero. So that means every dollar that you sell in a sale is actually taxable. But with the right structure, it's sometimes possible to increase your basis on part of the business, and it legally reduces the tax hit before the sale. We helped one family bring in a trust they controlled as a minority partner. That trust purchased a small interest at fair market value ahead of the sale, which stepped up the basis for that piece. When the final sale occurred, that slice that they had sold to the trust had significantly lower tax exposure. Now, this may sound complicated, but understanding these strategies earlier would have saved most business owner millions. It's obviously better to discover them when they still matter. When you start combining tax strategy with estate planning, that's where you can see the most dramatic results. So if your business is worth $30 million or more, you're not just dealing with capital gains, you're also entering estate tax territory. We worked with a client who moved 20% of their shares into a trust a year before the sale. That 20% slice grew from $5 million to $9 million before the closing. That extra $4 million in appreciation was gone from their estate. So that move saved their kids and grandkids $1.6 million in future estate taxes. Unfortunately, these strategies, they don't work at the last minute. You actually need valuations, you need legal structure, you need to coordinate across your teams. It's better if it's usually 12 to say 24 months before the sale. But when you plan early, you gain control. You decide how much goes to the IRS, how much supports your family, and what you're going to use that money for your next chapter. So if you're thinking about selling your business, even if it's still hypothetical, there's a link below to schedule a call. You'll walk away with insight based on your situation and timeline, and also hopefully discover some tax strategies that maybe you haven't heard of. I really do love making these videos, and I hope you'll join me on the next one.